Good afternoon, good evening, and good morning to all my friends and viewers and small YouTubers. Welcome to my live stream. Shout out to Juanita. Shout out to Juanita Peralta. Welcome to my channel. My topic is all about money, credit, and banking monetary theory. Monetary theory explains the role of money in the economic system. It's evident that money in its various uses affects production, distribution, and consumption in its various uses and affects production, distribution, and consumption of goods and services. Hello po, Juanita Peralta. Welcome po. Good afternoon. With the existence of monetary theory, the workings of the economic system are better understood. For instance, why do prices increases? That is the question. Why does the production decline? Second question. These are a very familiar economic problems whose causes are clearly related to the use or values of money. Monetary theory is simply the theory of the value of money. There are three theories which explains the exchanges in the value of money: transaction theory, cash balance theory, and income theory. The first theories stress the value of money as the main determinant of economic activities, while the income theories emphasize the flow or uses of money and not its value, which causes changes in economic activities. This chapter presents the two viewpoints of monetary theories and their effects of the economy, in addition the three monetary theories. Together with their corresponding illustration are explained. Moreover, the quality theory, acquisitions of any of or any credit upon the security of any obligation or claims arising out of any of the foregoing and any transaction or series of transaction having a similar purpose or effect. Finance charge includes interest fees, service charges, discounts, and such other charges incident to the extension of credit as the Monetary Board of the Central Banks of the Philippines may by regulations prescribe. Creditor means any persons engaged in the business of extending credit, including any person who has a regular business practice, makes loan or sells or rents property or services on time, credit or installment basis, either as principal or as agent, who requires as incidents to the extension of credits the payments of the finance charge. Information to be furnished by the creditor. Any creditor is required to furnish to each action to whom credit is extended prior to consummation of the transaction as clear statement in writing setting forth to the extent applicable and in accordance with rules and regulations prescribed by the Monetary Board the following information. 1. The cash price or delivered price of the property or service to be acquired. 2. The amounts of any to be credited as down payment and or in trade-in. 3. The difference between the amount set forth under clauses 1 and 2. 4. The charges individually itemized which are paid or to be paid by such person in connection with the transaction but which are not incident to the extension of credit. 5. The total amount to be financed. 6. The finance charge expressed in terms of pesos and centavos. And 7. The percentage that finance charge bears to excuse me, to the total amount to be financed expressed as a sample annual rate on the outstanding and paid balance of the obligation. Regulatory agency. Regulatory agency. The Monetary Board of the Central Banks of the Philippines is authorized by law to prescribe rules and regulation as may be necessary to carry out the purposes there are corresponding adjustment in salary and pension. But galloping inflation, about 30% increase become disruptive investment, production and consumption. The worst is astronomical inflation in which the price level increases by 100%, by 5%, 500%, or even higher. This is the kind of inflation which we have been experiencing in recent years. Based on even data, bank statistics, the inflation rates in October 1983 was 9.10%, while in October 1984 it was 63.82%. With such inflation rate in the Philippines, 71 out of every 100 families were below the poverty line, which was 2,503 a month. There have been several government measures to combat inflation. For instance, people were encouraged to return to the rural areas to plant vegetable crops. Others have been told to economize by eating edible grasses and insects. Even the chicken feed, popularly known as Adidas, became very rare and expensive. Many years ago, these were just thrown away on the part of producer. Inflation means higher cost of production. To continue making profit, they have to increase the prices of their good. It is basic law in economics that when price increase, quantity demanded decrease, all other things being constant. When demand for their products fall, production subsequently slow down. This means an increase in unemployment. The use of money. The income theory claims that the use of money. Shout out to Salve Malaya. Good afternoon po. The use of money. The income theory claims that the use of money can have a great influence of an economic activities, even though its value does not change. Income theories believe that their theory is better than the money of value of theories, transaction and cash balance theories, because it clearly show how to the flow of income of money causes economic changes. Income theory also provides a better foundation for government policymakers. As to the use of money, people have the several options. They can spend or save their money, or they their can make their saving available for investment, or just keep their money inside their houses. Such decision affects the money in terms of investment, employment, production, and consumption. For example, when savings are greater than investment, it means the resources of the economy are not fully used. There is less production, less employment, less income, less consumption, and so on. Income theorists believe that the value of money theories were only suitable during the early years when the economy was highly competitive and when prices were determined by demand and supply forces. Such economic conditions are adequately explained by the theories that price level changes in accordance with the changes in the quantity of money and its velocity. The transaction theory. The transaction theory state that the value of money, like goods and services, is determined by demand and supply in a given market at a given time. The three determinants of money value are the average quantity of money available, its average velocity, and the volume of trade. If there is an increase in the supply of money without a change in the demand for money, its value falls. This means there is an increase in price. On the other hand, if there is an increase in the demand for money without a change in the supply of money, its value rises or price level goes down. It can be stated, therefore, that other things remaining equal determinants of the value of money, the general price level varies in direct proportion to the supply of money and inverse proportion to the demand for money. Kent, 1970. Transaction equation of exchange. PT equals MB. P is the general price level or average price level paid for goods like rice, shoes, lumber, etc. M is the average quantity of money available throughout a year or other period of time. V is the average velocity of money in the same period, or the number of times the money is spent in 1 year. T is the volume of trade, number of transaction or total number of goods, services, and financial instruments that are brought in the market in a given period. Hence, MB constitutes the supply of money and T represents the demand for money. To determine the price level, we have to transpose the equation of exchange. PT equals MB. P equals MB divide T. The supply of money, MB, the numerator, and the demand for money, T, is the denominator. If the supply of money increases without change in the demand for money, then the price level P also increases. But if the demand for money increases without change in the money supply, then the price level decreases in inverse proportion. Assuming that M equals 1 million, B equals 18, and T equals 12 million, what will be the P? The solution is shown below. P equals MBT divide T equals 1 million then velocity is 18 divide 12 million equals 18,000 divide 12 million 18 million divide 12 million equals 1.50. No, again, P equals MB divide T, so equals 1 million close parenthesis 18 open parenthesis 18 close parenthesis divide the 12 million equals 18 million divide 12 million equals 150. Thus the equation MB equals PT will be 1 million. So that is a multiplication. No, time is 18 equals 18 million. 1 million times 18 equals 1.50. 12 million equals 18 million. So the above equation illustrates the simple fact that the money spending side MB equals the value of all transaction PT. Now, considering the original assumption that will be P if there is change or either the following other factor remain the same or constant. Number 1, M is increased by 200,000, B is increased by 6, T is decreased by 2 million. 4, M is decreased by 300,000. 5 is decreased by 6. 6, T is increased by 6 million. The answer for the problems are as follow. 1 is P equals 1.82, P is 2, 3P is 1.84, P is 1.05, 5P is 1 point, P is 1, 6P is 1. Thank you for coming, Salve Malaya, to my live stream. The above figures are indicative of the fact that prices will rise if there is a corresponding increase in M or B or decrease in T. On the other hand, prices will fall in a corresponding decrease M or B or increase in T. In all nutshell, the transaction equation explains the interdependency existing among the quantity of money, its velocity, rapidity, the quantity of transaction, and the level of prices over a period of time. Both the cash balance and transaction theories determines the value of money through the demand and supply relationship, but the supply of money in the cash of balance theory refers to the cash balances or money holdings of the people, not to the velocity of money as recognized by the transaction theory. People like the whole to hold cash liquidity, preference for transaction, precautionary or speculative motives. We like to retain a cash balance to be able to buy goods and services in the future or to be able to meet unexpected expenses like accidents or sickness. Business corporation, on the other hand, maintaining cash balances for financial stability or future investment. The decisions to hold such cash balances depends on the economic condition of the individual and corporation. For instance, a person with a good and regular income has lesser needs for cash balance. A new business firm must to retain bigger cash balance to be able to meet its daily financial transaction and pay for the salary of its worker. Cash balance equation M equals KTP. M is average quantity of money available. K is the proportion of the year volume of trade over which the people decides to retain their purchasing power in terms of cash balances. T is the volume of trade or total quantity of goods, services, and property rights that are bought in a given period of time. P is the average of price of goods, service, and property rights. Thus, KT is the demand for money and M is the supply of money. The cash balance equation M equals KTP simply state that the purchasing power of the available money is the form of cash balance is equal to the value of commodity, services, and property rights. Follower of the cash balance theory conclude that other things remaining equal, the general price level varies in direct proportion to supply of the money and in inverse proportion to the demand for money. This is shown by transposing the cash balance equation. P equals M divide KT. M the numerator is the supply of money and KT the denominator is the demand for money. If M increase without a change in KT, then the price level P is also increased in the same proportion. And if KT increase without a change in M, then the price level decrease in inverse proportion. B is the transaction equation and the K is the cash balance equation are closely related. Both are determined by exactly the same forces. The velocity of money depends on the decision of the owners spend or save it. Velocity of money become greater when people decide to spend their money as fast as they can. Keeping or hoarding money for the future purchase decrease the velocity of money. Obviously, V and K are reciprocal to each other. If B is 12, then K is 1 and 12. 1 over 12. Assuming that 1 million K is 1 6 and T equals 12 million, what will be P? The solution is shown below. P equals MK divide KT, 1 million equals 1 million divide 1, 1 6 equals 12 million, 1 million equals divided by 2 million equals 0.50. Thus the equation M equals PKT will be 1 million equals 0.50 times 1 point times 1 over 6 open parenthesis 12 million close parenthesis 1 million equals 1 million. Now reverting to the original assumption, what will be P if there is an exchange or either or both of the following other factor remaining the same constant? 1K is increased from 1/6 to 1/3. 2. T is increased from 12 million to 15 million. 3K is decreased from 1/6 to 1 over 24. 40 is the decrease from 12 million to 6 million. The answer for the above problem are as follow. 1P is 0.25, 2P is 0.43, P is 2, 4P is 1. The above figures are by all means demonstrative of the fact that increase in either K or T or both will result in the falling prices and the decrease in either K or T, or both will result in rising prices. Summing it up, the cash balance equations relates the dependency among the supply of money, the quantity of money, and the demand for money at a given point of time. Quantity theory of money re-emphasized. The quantity theory of money states that the order things remaining unchanged that change the quantity of money will result in proportional changes in the price level. Thomas, 1957. Stating in another way, the quantity theory of money expressed the view that change M cannot cause change in B and T. However, change in M will result in proportional changes in P. This point has been described in the transaction equation MB equals PT. Also, its modified form, the equation is now expressed in a formula PT equals MB plus MB, where M refers the amount of money substitutes credit instrument and B refers to the velocity rapidity of money substitutes. That's what will be the price level P. If M equals 1 million B, 18 M equals 1 million, B equals 18, and T equals 24 million. The solution is shown below. P equals MB plus MB divide T equals 1 million, open parenthesis, 18 close parenthesis, plus 1 million, open parenthesis, 18 equals close parenthesis, divide 24 million equals 36 million, divide 24 million equals 1.50. Undoubtedly, the quantity theory is a useful tool in understanding long-run monetary and economic problem. Nevertheless, it is useful in a short-run problem of economic of monetary stability is not a remote possibility. Income theory. The income theory maintains the changes in the economy are not influenced by the changes in the value of money or price level. For instance, shift in employment levels and output can place through monetary influences even without change in the price level. The theory stresses the production of new goods and the speed of spending factor or incomes, wages, rents, interest, and profits for products. It explains the working of the economic system through the interaction of the various aggregates like investment, income, consumption, and savings. The value of money, according to theory, is determined by the saving investments relationship. If saving S are equal to investment I, there is no movement in the price level. If savings are greater than investment, there is a downward pressure on prices. On the other hand, if investments are greater than savings, there is an upward pressure on prices. In such relationships, saving refers to the supply of money and investments to the demand for money. When a businessman put up a factory, this is a form of investments. Few investors have sufficient cash for new enterprises, so they borrow from banks or the other financial institutions to finance their business project like bigger fish funds, supermarket, etc. as funds or loans come from saving. However, the income theories contend that changes in prices do not depend only on savings investments relationship but also on the availability of the idle factor of production, labor and capital, and the degree of control made by the enterprises in the various fields of the country. First of all, it was John Maynard Keynes who developed the fundamental equation y equals c plus I, where y being aggregate income, c being the amount spent for goods for consumer, I being the amount spent for the consequently received in the production of investment goods capital sold in 1963. For such a basic equation, other useful equation may be clearly inferred in deduced like y minus equal s, where s being the amount of savings left between aggregate income less than the amount spent for consumption, y equals c plus I, y equals c plus s, I equals y minus c, therefore s equals I. Now, if intended saving equals investment, the economy is in equilibrium and such either investments or saving is unaffected. How about when saving is less or greater than investment? The following presentation will visibly describe and answer the question raised earlier. Firstly, if saving is equal investment, S equals Y is stable, Thomas 1957. To illustrate, assume that Y equals 20,000, S and I are both 20% of Y. Hence, hmm. First, monetary theory. Y equals 20,000 utilized. Second, expenditure. C, 16 pesos. I equals for 16,000 pesos. I equals 4,000 pesos. S equals 4,000 pesos. 16,000 plus 4,000 equals 20,000 pesos. So CI utilize by saving 4,000. Expenditure, third, C 16,000 pesos, I 14,000 equals 20,000 pesos. Utilize savings 4,000. Secondly, if saving is less than investment, S is greater than Y rises, the illustrate assume that Y 20,000, S is 10% of Y, and I is 20% of Y. Thus, first, 20,000, Y equals 20,000, utilize. Second, expenditure, 18,000, I equals 4,000, Y equals 22,000. This hoarding a new bank credit 2,000. So, utilize saving equals 2,000. Utilize third, expenditure 19,800, I equals 4,400, Y equals 24,200. This hoarding a new bank credit is 2,200. Utilize savings equals 2,200. Thirdly, if saving is greater than investment, less than Y falls. To illustrate, assume Y 20,000, S is 20% of Y, and I is 10% of Y. Sige po, exit na po kayo. Atin na lang po ako sa ano sa yung ano premiere. Kailangan kong tapusin yung topic. Now let's continue. Third, expenditure C equals 14,400, I is 1,800, total Y equals 16,200. Cash hoard 1,800 and repayment of bank loan utilize 3,600. Question for review and discussion. Number one, the different shade qualitative theory for quantitative theory. To what theory stress the value of money as the main determinant of economics activity? 3. State the meaning of equation of exchange. 4. Give at least two equation of exchange. 5. If there is an increase in the money supply without corresponding increase in production of good, what are the economic effects explained? 6. What are the different motive for holding cash? Explain. Number 7. Define monetary theory. Explain one monetary theory. And lastly, number 8. Explain one effects of the value of money on the economy. This is the end of money, credit, and banking monetary theory. Now, let's go to the second topic, central banking. Atin na lang po ako sa inyo, Salve Malaya, sa inyong premiere mamaya. Tatapusin ko lang yung mga topic ko about sa banking, credit, and money. Okay. Central banking. A central bank assumes a very vital role in the development and growth of the economy through its various monetary tools. It can regulate the monetary and credit condition of the country. Moreover, a central bank can increase investments, production, employments, and incomes. Likewise, it can be stabilized together with fiscal policy the economic situation of the nation. Such tremendous influence of the central banks of the whole economy requires a high degree of competence and integrity from those who are in charge with the formulation and implementation of monetary policies. As a matter of principle, a central bank must be demonstrate an unquestionable independence from any political consideration which affect adversely in its function. Reason for this is to enable the central bank to pursue effectively its objective. A central bank is envisioned primarily to promote economic growth for the welfare of the people, especially the poor, and not to serve the interests of the elite and those who are in power. The central bank has launched as a crusade for sound and responsible banking in order to strengthen further the banking system. Such crusade has been intended to infuse vigor into the financial community by eliminating its weaknesses. Former CB Governor Jose Fernandez pointed out the need of reforming the banking systems to make it effective tool in mobilizing new resources which are needed for the country recovery efforts. The central bank's criteria for sound and responsible banking are prudence, service to the community, and commitment to the development efforts like mobilizing investment saving. This chapter presents a general information on central banking such as function, monetary tools, credit control, creation of money by the banking system, and other topics. Central bank defined. By and large, the meaning of central bank may be better understood and conceptualized by reviewing the provision of the law that created it. Section 1, 2, 64, and 67 of Republic Act number 265 as amended adequately fills such a needed. As such, a central bank may be referred to as a body corporate entrusted with the responsibility of administering the monetary, banking, and credit system of the country with due regards to the availability, use, the cost of money and credit for the attainment of a balanced and sustainable growth of the economy as well as the maintenance of internal and external monetary stability in the country. Nonetheless, before the advent of the 20th century, there has been a loose and vague concept of central banking. As a matter of record, the banking institution in the past that substantially performed the whole role of central bankers in many countries of the world were referred to as bank of issue or national banks. Significantly, by the Bank of England, founded in 1694 as a joint stock company, earned the accolade of being crowned by as the mother of all central banks. Do not the first, though not the first one of the established for the development of the art of central banking or simply the job of the ideal central bank. Objectives of the central bank. Central bank as amended provides that the responsibility to administer the monetary banking and credit system of the Philippines Republic is inherent upon the Central Bank of the Philippines. It is likewise the duty of the central banks to use all the powers vested to it by law to achieve the following objectives. One, primarily to maintain internal and external monetary stability in the Philippines and to preserve the international value of the peso and its convertibility into other freely convertible currency. And number two, to foster monetary credit and exchange condition conducive to balanced and sustainable growth of the economy. With the above objectives in mind, it will be logical to consider central bank for purposes of contrast and comparison. The United States Federal Reserve System is a good example. It is a system of 12 connected banks called the Federal Reserve Bank. Each have one geographical section of the country as its sphere of operation. The enabling law is the Federal Reserve Act. The considered objectives may be summarized as to help counteract inflationary and deflationary movements and to share in creating conditions favorable to sustain high employment. Stable values growth of the country and a rising level of consumption, the Federal Reserve System 1951. However, it must be pointed out that the main function of the Federal Reserve is to regulate the flow of credit and money. Considering what has been said so far, it's not uneasy to visualize and reflect why the Central Bank Act and the Federal Reserve Act, respectively, of the Philippines and the United States have an almost, if not identical objectives. That rationally is due to the fact that the central bank is expected to perform its important and pivotal role in bringing about economic stability and growth. Indeed, steering the economy to an even keel is far from easy. Hence, there is a need for cooperation and coordination of policy between the fiscal and monetary sector. The central bank, which is being referred to as the monetary sector or seat of monetary authority, is not wanting of methods, tool, or instrument of monetary management's credit control, is bringing about desired goals of economic stability and growth. These instruments or tools monetary control may be divided in general quantitative and selective qualitative. Needless to say, depending upon the purpose of particular tool or instrument of monetary management, may be regarded as producing a tight or easy money policy. Open market operation discount rate reserves requirements of are example or general monetary or credit control, while margin requirements on letter of credit and other selective credit are example of selective instrument of monetary regulation. Chander and Goldfield, 1970. Function of the central bank. The so-called ideal jobs are follow. 1. As fiscal agents of the government, later on added that this responsibility is twofold, such as banker and financial advisor of the government. 2. As a caretaker of commercial banks reserve, this refers to legal reserves requirement. 3. As manager of international reserve of the country consisting of gold and foreign exchange. 4. As issuer of notes, legal tender money. And 5. As regulatory of control of credit. Of course, central banks of today have acquired additional function, responsibilities, and powers to cope with the dynamism of modern economic system. Future of a central bank. A central bank that is called a bank is not really a bank in the sense and the manner an ordinary banks operate. Essentially, the following characteristic of a central bank clearly differentiate in a form other types of banks. They are: number one, except in isolated cases, the central bank is said not to be directly dealing with any particular individual or individuals or the public at large. 2. Although the central bank may realize profit from its operation, it is definitely organized or created not for the purpose of profit making or profit seeking venture. 3. As a body corporate owned by the government, is expected to fulfill its role as an agency of the government in implementing public policy. 4. There is no doubt that the ordinary banks are subordinate to the central bank in the sense that the latter exercises supervision and regulation over monetary credit and banking system of the country. 5. The central bank serves as the leakage or the connecting link between the banking system and one of the country and that another of the rest of the world. The Central Bank of the Philippines. The Philippine Central Bank has come a long way since its official inauguration on January 3, 1949. At the time of it had only little over 100 employees. Today, it has well organized staff over 3,000 employees, also with more than $1 billion international reserve as against 420 million in January, $420 million in January of 1949. From then on, the Central Bank of the Philippines maneuver the country's monetary and banking activities to extraordinary growth through exchange and traditional control in the 1960s monetary credit control in the so-called laissez-faire economic with the modified fixed exchange rate in the 1960 and in the 1970 to unrestricted exchange rate or otherwise refers to as the floating peso for putting back in the economy of the pathways of stability. Of course, in the 1980s, there was the restructuring of the banking system. Banking laws were amended to give way to so-called universal banking, unexpanded commercial banking authority together with the lifting interest ceiling on deposits. The role of central banks. In his speech delivered during the commencement exercises of the Central Philippines University, Iloilo City, March 30, 1970, then Governor Gregorio S. Licaros of the Central Bank stressed the role of the Central Bank of the Philippines in the process of development as chartered in the 5 years development plan of the new society. The erstwhile while the Fourth Republic, he underscored the fact that the crystallization of such noble aspiration from the standpoint of the monetary authority was to ensure a strong monetary foundation and adequate resource inputs to the development process. Consequently, the same source pointed out the policy mix adopted by the monetary authority in the development oriented administration. They are: one, bank capital build up, increased capitalization of banking institution; two, regional dispersal of credit and financial institution ability. Availability of funds must not be limited or concentrated in Metro Manila, but made available even to remotest areas of the country. Three, rationalization of interest rate structure, example in the upgrading of interest on deposit. Four, credit allocation to or agro-industrial development such all move will speed up the country industrialization process. Five, careful international debt management, ensuring prompt payments or otherwise of our mature international obligation. And six, other components of monetary innovation clearly than the laudable performance of the Philippines economy and the central banks of the Philippines are discernible from the following. The expansion of the Philippine economy is the last 5 years is evident to all of us. We have attained continuing growth and stable prices in face of international recession and inflation. We have succeeded in earning our surplus in external accounts. Money supply, domestic liquidity, and credit increase in support of a 7% GNP growth target. Per capita GNP in current terms reached $460 in 1977 as a compare with 1993 in 1970. The result of our development-oriented public service are self-evident. We have attained self-sufficiency in rice production and have in fact exported rice to Malaysia and Indonesia. The standard of living in the countryside has dramatically improved. More indigenous products has been produced and more jobs created. More agri-based industry have taken root. The price and international payments record of the past 5 years are among the most expressive among the countries of the world. Philippine Daily Express, 1978. The central bank today. Montagu Collet Norman, Lord Norman, former governor of the Bank of England for 24 years, philosophy conceptualized the present-day role of the central bank. According to him, the central bank has the unique right to offer advice and to press such advice, even to the point of nagging, but always, of course, subject to the supreme authority of the government, Sino 1976. Undeniably, this view is influenced by the modern-day central banks. These kinds of thinking may be the logical uses why almost central bank of the modern-day world are governmental institutions. For instance, the Bank of France was national in 1945, while the Bank of England followed suit in 1946. Indeed, Lord Norman pronouncement has found its way in the enabling law that created the Central Bank of the Philippines. In particular, the Central Bank Act as amended provides that before undertaking any credit operation abroad, government through the Secretary of Finance shall request the opinion and writing of the Monetary Board on the monetary implication of the contemplated action. Such opinion must similarly be requested by all political subdivision and instrumentalities of the government before any credit operation abroad is undertaken by them. The opinion of the Monetary Board shall be based on the goal of and foreign exchange resources and obligation of the nation and of the effects of the purpose of operation of the balance of payments and on the volume of the money supply. Where the government or any of its political subdivision or instrumentalities contemplates borrowing with the Philippines, the prior opinions of the Monetary Board shall likewise be requested in order the board may render an opinion of the people effects of the purpose operation of the money supply, the price level and the balance of payment. As mandated by law, the central bank via the monetary boards occupies a very peculiar position of giving advice to the government, its political subdivision, and instrumentalities. If the government is not receptive to the advice in spite of all persuasive effort of the central banker, the latter will have to succumb and cooperate with the former, minimizing the ill effects of such credit operation domestically or internationally. This can be accomplished by putting a squeeze commercial bank and other banks credits operation, as well as other financial institutions. Central Monetary Authority. The 1973 Philippines Constitution provides the following: the Batasan Pambansa shall establish a central monetary authority which shall provide policies direction in the areas of money, banking, and credit. It shall have the supervisory authority over the operation of banks and exercise such regulatory authority as may be provided by law over the operation of finance companies and other institutions performing similar function until the Batasan Pambansa shall otherwise provide. The central banks of the Philippines operating under existing laws shall function as the central monetary authority. The implementing law of the above constitutional provision was Presidential Decree number 1801, which constituted the central banks of the Philippines as the central monetary authority. Monetary Board. Monetary Board is the policy making body of the Central Bank of the Philippines. It is vested with monetary and credit authority. The members of the Monetary Board are the governor of the central bank as the chairman, as cabinet member, and 5 members from the private sector who are appointed for their integrity, experience, and individual expertise as members. The Monetary Board has following powers. 1. Prepare and issue rules and regulations for the effective discharge of the responsibilities and exercise of the power vested in the central bank. 2. Direct the management, operation, and administration of the central bank and prepare the necessary rules and regulation for the purpose. 3. Appoint, fix the remuneration and other emolument and decide of the removal of central bank personnel except the governor. And number 4, authorize such expenditure of the government in the interest of its effective administration and operation. Monetary policy. Monetary policy is a process whereby the monetary authorities attempt to achieve a desired set of economic goals by controlling money and supply, cost and availability of credit, of the allocation of credit to its various use. Both on 1975, monetary policies are formulated by the Monetary Board and implemented by the central bank through its various monetary tools. As such, monetary policy should be flexible and dynamic. It should be conducive to the changes, needs, and problems of the economy, but above all, it should be promote not only the economic growth of the country, but also the social justice of the credit system. In view of the financial crisis which the country has been experienced for some years, the policy of the central bank is to stress domestic financial mobilization Thus, there is need for bringing about more prudent banking as greater safety for the funds of the depositing public in this connection. Bank consolidation or merger is being encouraged by the central bank. The central banks believe the big banks are more efficient and stable. However, monetary policies have their own weaknesses without the corporation support of fiscal policies, taxation, government borrowings, and government expenditure. Monetary goals like economic growth and monetary stability are difficult to attain. For instance, in controlling inflation or excess liquidity, the monetary tools are useless if top government officials are very extravagant in funding their projects. Another criticism is that our monetary policy are being dictated by the WB and IMF whenever our country applies for loans from them. Services of the central bank. Some of easily identifiable things being done or performed by the Central Bank of the Philippines are as follow. Number one, supervise and regulates operation of banking institution. Two, regulates operation of non-banking financial intermediaries. Three, regulates foreign exchange. Four, regulates credits. Five, issue money. Six, mints coins and prints paper money. Seven, keeps reserves. Eight, clears checks. Nine, prints check. 10, prints government security. 11, grants loan and advances. 12, buys and sells government securities. And 13, collect revenues for the government. Imperative of monetary management. The abandonment of the gold standard and in its various modification gave way to a new era of monetary system, the birth of managed currency system. The same thing may be said to occurred in the Philippines when the Central Bank Act, as amended, came into law, establishing in the process the Central Bank of the Philippines with the responsibility of administering a new monetary system known as the managed currency system. This particular system has been more flexible and responsive for the changing needs of the economy. The importance of monetary management is felt is there is an actual want or absence of it. Thus, the banking sector, in a particular the commercial bank, with their capacity to create money, may overextend credits during periods of prosperity or may do the opposite during periods of decline or depression of the so-called business cycle and creating thereby in the process economic fluctuation refers to an inflation and deflation in as the case may be. Hence, Leslie P. Singer, Economics Made Simple, has commented that in most modern economy is the policy of the central bank to prevent such movement when the commercial bank system overexpand or is in the process of overexpanding. The monetary authorities apply the brakes when the commercial banking system has contracted against or its process or contracting to must the monetary authority loosens the brake or the step of the gas pedal to give the banking system a fresh start. The entire provision of the Central Bank Act as amended by interpreted to have provided a sufficient means of action for the Central Bank of the Philippines to achieve the domestic and international objective of the national monetary policy, specifically the monetary board shall rely on its moral influence, the powers granted to it under the law for the regulations of money, credit, exchange, and the support of corporation, cooperation of the government and all its agency. Major tools of monetary management. Among the different instruments of monetary management, open market operation, reserve requirements, and moral suasion, moral influence are given extra emphasis. Open market operation reliance on this particular tool of monetary control and as mean of stabilizing the market for the government security in the Philippines itself in the Philippines may be considered to be sold as the central bank of the Philippines itself, if not older. This is so because there was, for instance, an outstanding government security of 16.8 million in 1968 million pesos in 1949. The amount has since augmented to 28,249 million in 1978 per the 1978. Open market operation as conducted by the central bank has been premises on the specific provision of the Central Bank Act as amended. The general principle under which open markets operation are to be undertaken may be found in Section 96 as the said law is provides that the conduct of open markets purchase and sales of security by the central bank may be made exclusive for the purpose of achieving the objective of the national monetary policy and therefore be limited to the purchase and sales of government securities as well as the issue and negotiation of central bank obligation. Accordingly, in a period of inflation or as long as inflationary danger exists, the central bank must refrain from open market purchase and at such time endeavor to reduce its security holding in order to sell its own certificates of indebtedness. Conversely, whenever the national monetary policy requires any expansion of the money supply, the central bank may repurchase its own evidences of indebtedness prior to their days of maturity or may acquire purchase other government security in the open market. In purchasing said security, the central bank must give preference to short-term obligation in order that the bank may be in a better positions to reduce the money supply should condition in the future so require. Guidelines in government security. The guidelines in the issue of methods of placing government security are appropriate to pronounce in Section 122 and 123 of the Central Bank Act. As amended, the former provides that the issue of security representing obligation of the government's policies, subdivision, or instrumentalities is coursed through the central banks acting as agent of and for the account of government or its respective subdivision or instrumentality as the case may be. In so doing, the central bank is acting only a pure of said security and is the same time not guarantee their placement, while Section 123 authorized the central bank to place the government security through the direct sales to financial institution and the public through the outright sales to syndicate, the brokers of the dealer, the purpose of resales to the contracted to the place the security with the public for the account of the central bank. The Central Bank of the Philippines is likewise mandated by law to administer the Security Stabilization Fund for the account of government, in particular the central bank account, as amended provides that the operation of the securities stabilization funds by directed in the purchase and sales into the open markets of bonds and other evidence and indebtedness issue or fully guaranteed by the government of the public of the Philippines. The purpose of this operation is to increase the liquidity and stabilize the value of said securities in order thereby to promote private investment in government obligation. By the large open market operation as a tool of monetary regulation or avail of to increase or to decrease money supply is respective of the kinds of security involved, while open markets operation as means of stabilizing government security prices may refers only the specific or particular kind of security whose value is targeted to be stabilized and the magnitude of this operation is limited by the size of the particular debt issue, Beans 1978. Says government security. It's September of 1978. The Central Bank of the Philippines adopted the auction method in the sale of central bank certificates of indebtedness with the redesigned features for the purpose of providing the spark plug necessary in the attainment of the abroad objectives of the yields rationalization program. The investor responded enthusiastically and favorably of this regard per the 1978. It is safer to say the effectiveness of open market operation as a tool of quantitative monetary regulation developed countries is undeniably beyond question for resistance. The Federal Reserve System Bank of England and Reserve Bank of Canada have extensively relied upon market operation as an instrument of monetary control. Such reliance may be due to the greater effectiveness and flexible. For example, it can be brought into action quietly without fanfare that accompanies announcement of changes as in reserve requirements and discount rates since 1978. Finally, it is worthy of note that the open markets purchases of the redesigned and restructured CBCI conducted by the Central Bank of the Philippines has been encouraging the right direction in honors may be constructed from the following. Philippines Evening Express 1979. During the first quarter of the year, 800 million would sold out. Additional blocks of 200 million each have likewise been scheduled for May and June. Additional blocks of 200 million each have likewise been scheduled for May and June. Sales proceeds of this auction are earmarked for dispersal of the countryside for small medium scale industry as well for export oriented projects. In our earlier reports to the President of Philippines economy, CB Governor G.S. Licaror stressed that the central bank would be make full use is to open market operation to curtail inflation and regulate liquidity that may be generated in the system by the price increases. CBCIs constitute a major instrument for this purpose, and all previous CBI auctions have been consistently marked by oversubscription. CBCI are eligible alternative investment of unloaned funds for agricultural and agrarian preferred credit. As redesigned, CBCIs carry a 4-year term, bear a taxable interest coupon of 9% per annum payable semi-annually and are available in denomination of 10,000, 50,000, 100,000, and 500,000. They are direct and conditional obligation of the central bank. Reserve requirements, the principal consideration why banks operating in the Philippines are required to maintain reserves against their deposits liability is to be able to central bank of the Philippines to control the volume of the money created by the credit operation and since banking institution that require reserve as each bank in a proportion to the volume of its deposit liabilities ordinarily takes the form of a deposit in the central banks of the Philippines. Nevertheless, the monetary board may, whenever circumstances warrant, permit the maintenance of part of the deposit maintenance as part of the required reserve in the form of assets under the peso deposit with the central bank. The reserve requirements are applicable to all bonds of the same category uniformly and without discrimination. On the other hand, the latter provision authorizes the monetary board to prescribe and modify the minimum reserve ratios applicable to each class peso deposit. Such ratio, however, be not less than 5% or more than 25% for time and saving deposits and be not less than 10% or more than 50% for the demand deposit. Needless to say, a higher reserves of ratio result in contracting credit while a lower reserve ratio result in expanding credit. Basically, it may mean contraction or expansion of money supply as the case may be. The principle herein enunciated is likewise applicable to other tools of monetary management, namely discount and rediscount rate. Multiple expansion of banks deposit is it is certainly interesting to see that the bounding effects of a leakage between open markets operation and the required reserve ratio against deposit. Consider for the instance that the legal reserve ratio requires against deposits 20% and the central bank goes to the market and buys, say, a 1 million peso worth government bonds. Surely the community money supply will go up to buy 1 million pesos and available credit will increase that much. However, it's the people who sold the bonds of the central bank deposit that proceeding bank or pay them out to some who else will make such deposits. A multiple expansion of bank deposits is likely to occur. The members bank of the banking system will now have at least forfeits and 1 million pesos excess reserve on inducements to go out, acquire new earnings, assets, loan, and investment. Sooner or later, the banking system as a whole will experience 5 million pesos expansion in bank deposits. This can be approved by the algebraic equation as follows. Samuelson, 1964. So creation of money of the by the banking system equals 1 million plus 800,000 plus 640,000 plus 512,000 equals 1 million I plus 4P plus uh, close parenthesis 4P plus open parenthesis 4P plus equals 1 million plus I divided by 1 minus 4P equals 1 million times 5. A summary possible 5 is to 1 leverage on the money supply resulting from market purchase are shown below. Effects of a 1 million peso open market purchase assets, liabilities, investment, 1 million legal liabilities, 1 million, total 1 million. Final effects of member bonds, 1 million open market purchase, legal rest 1 million, deposits 5 million, investments 4 million, total 5 million. If it is an open market sales rather than purchase, the reverse effects may ensue as legal residence 1 million, loans investment 4 million, total 5 million, liabilities deposits 5 million, total 5 million. Creation of money by banking system. This is an illustration of multiple expansion of bank deposit. There are 5 banks, A, B, D, and E. It is assumed that the reserves requirement is 20% and its constant bank A has primary deposits of 100. Based on these deposits, the demand deposits of the other or 4 banks can be expanded. As an example, let us say Christina has deposited 100 is a bank A. The bank does not keep the money of the Christina. It has to lend it to somebody in order to earn an income. Since the reserves requirement is 20%, bank A can only lend 80%, supposing Olivia borrow that 80% of both a pair of shoes for Schumart was Schumart deposited 80 in Bank B. Likewise, Bank B can only lend 80%, which in 64. Even if I was saying the 64 purchase ball pen from National Bookstore, the owner of the store deposits the 64 in bank. Since the same process is applied in the Bank B and Bank E. As a result, the Pride Bank has created a total deposits of 336.16 and total loans 268.94 pesos. All that came from the primary deposits at Christina. Sino bang A? The tables below illustrate banks A, B, C, D deposit ng A up to E 100,000, 80 pesos, 64, 51.20, 40.96 reserve 20 pesos, 16, 12.80, 10.24, 8.90 loans 80 pesos, 64, 51.20, 40.90, 32.77 total 300 total deposits 336.60, total reserve 67.23, loans 268.93 pesos. If more additional banks are involved, the total will reach 5 times the first amount, which is 100 pesos. This can happen as long as the reserve requirements of 20% is constant or each amount in the reserve is equal to 80% of the preceding amount. It is evident that more primary deposits can generate more in the banking system on. All right. On the other hand, withdrawals has deposit effect. Moral suasion, this particular tool of credit control is being referred in the law central bank account as moral influence. As a matter of fact, said law provides that the monetary board of the central bank shall rely on its moral influence for the regulation of money, credit, and exchange. The central bank conducts a series of consultation in the form of seminar, conference, meeting, or whatever form of interaction or dialogue with the representative of the banking sector and the public at large with the end in view of informing them in advance of what central bank is planning or intending to do in order to realize a given desirable economic object in those process, giving impressions that the central bank is amenable to suggestions and recommendations. The key to the whole thing is persuasion. Specific penalties. In closing this particular chapter, it's necessary to mention the specific penalty imposed by law to those person, entities, banking institution, non-banking financial intermediaries violating any rules regulation of the monetary board of the central bank and of any banking law section 32, 33, 34, and 34-A of the Central Bank Acts as amended are highly instructive and informative as to the penalties or sanction imposed to the non-followers or violators. Section 32 pertains to refusal to make reports or permit examination. Does any owner, agent, manager, or other officers in charge of any banking institution within the purview of the law who is being thereon to acquire in writing by the monetary board or by the heads of the appropriate supervising and examining the department willfully refuse to file the required report of permit, any lawful examination into the affairs of such institution shall be punished by a fine of not more than 10,000 pesos or by imprisonment of not more than 1 year or both in discretion of the court. Section 33 is a concern with the false statement. Hence, the willful making of false statement of the monetary board or the head of the appropriate supervising examining the department of this examiner is to be punished by the fine that exceeds 15,000 pesos or by imprisonment for a term that exceeds 2 years. Both is the discretion of the court. Section 34 is about violation of the law and regulation. The law being referred to is the Central Bank Act, while the regulation may refer to any order, instruction, rule, or regulation issued by the monetary board. As such, the person responsible for such violation is to be punished by a fine of not more than 20,000 pesos by the imprisonment of not more than 5 years. Administrative sanction of bank is covered by Section 3-A. The following administrative sanction are in addition to what may be imposed on refusal to make reverse permit examination, false statement, and violation of laws and regulation. One, fines not in excess of 500 pesos a day or each type of violation. Two, suspension of after due hearing, removal, direction, and or officer. Three, suspension of discounting privilege. Four, suspension of lending or foreign exchange operation or authority to accept new deposits of making new investments. Five, suspension of interbank clearing privilege and or six, suspension of authority to operate. The above administrative sanction need to be applied in order to their severity. Also, they must be applied to all banks of the same category, uniformly and without discrimination. Administrative sanction on non-bank financial intermediaries performing quasi-banking functions covered by the Section 34-B. The imposition of such sanction is dis, uh, dis, uh, discretionary of the part of monetary board of the Central Bank of the Philippines. The grounds are the same as mentioned with respect of banking institution or any commission of irregularities to administer sanction as follows. One, fine not in excess of 500 pesos a day for each type of violation. Two, suspension or after due hearing removal of these directors and or officers. Three, suspension of access to central bank and credit facilities. And or four, suspension or after due hearing revocation of quasi-banking license. The above administrative sanction need not be applied in the order of the severity. Question, money credit banking, central banking question for review and discussion. Number one, define central bank. Two, what are the objectives of central bank? Three, what are the tools of monetary management? Explain one of them. Four, state the penalty for violating provision of the central bank. Five, the state reason for the buying and selling of security by the central bank. Six, state some function of central bank. Seven, what are the administrative sanction on non-bank financial intermediaries performing quasi-banking function. 8. What is the monetary board? Who are the members? What are its power? That is number 8, three question. Three question in number 8. What is the monetary board? Who are the members and what are its power? And lastly, number 9, define monetary policy. What is a good monetary policy? Give your own comments about your monetary policy. This is the end of my topic, money, credit, and banking, central banking now. Let's proceed to next topic, global banking. All right. Global banking. In the beginning, international trade was conducted mainly for international exchange of goods. Agricultural countries exported raw materials and few primary crops to the industrial countries. The latter exported finished products to the agricultural countries. However, with the expansion of the international trade, international finance and investments emerged to support manufacturing. The industrial countries have invested their surplus funds in the economies of the developing countries' third world. Such investments were strictly financial in the nature and involved the flow of financial resources through banks, investment houses, and government. At the beginning of 20th century, some giant companies also emerged in the international business. Their subsidiary managed overseas operation. Said subsidiaries were treated as appendages appendages to the parent company and functioned chiefly as export agency. Their headquarters were located in North America, United States and Canada, and Western Europe, mostly in Great Britain, France, and Germany. Their warehouses, service offices, and sales agency were found mostly in the third world like the Philippines, Argentina, Costa Rica, and other poor countries where profits were abundant. The search for bigger market and bigger profits, among other, trigger the expansion of this corporation beyond the shore of the industrial West. Immediately after the last World War, the management of international companies was instructed to meet the needs of international business operation. Vice President for International Operation were appointed to act as contact and liaison with the various subsidiaries engaged in international manufacture and trade during 1960. Global companies gradually developed, therefore foreign operations were integrated into single organizational structure. Today we call them multinational or transitional or transnational corporation. These are corporations which maintain headquarters in a country, perform production, marketing, finance, and personal function with many of other countries. The owners of such multinational corporations are the industrial countries like the United States, France, Great Britain, Japan, and West Germany. In the case of banking, there also emerged transnational banks, which are international finance institutions which conduct their businesses in many countries of the world. These banks are special types of multinational corporations with specialized in global banking and international finance. Their clients are primarily the multinational corporation, government, mostly poor countries, and wealthy individuals. Such banks, like the other types of multinational corporation, have not escaped the criticism of nationalist economies. This chapter presents basic information about transnational banks and their participation in our financial system. Many of the high informative materials have been derived from the Philippines financial system, published by Ebon from the Philippines Financial System Data Bank. In addition, the rules of WB, IMF, and IDB and the negative impressions about them have been explained. Development of global banking. The roots of transitional banking can be traced from the world's colonial past. Colonial empires like the Great Britain, France, and Spain set up branches of their banking institution in their colonies to facilitate trade. For example, the British Empire established banks in their colonies to conduct foreign exchange operation and to provide short-term funds to both exporters and importers. And banks grow in the number as trade expanded. In fact, the British banking system was dominant even in our colonial period. The factory system started in England, and this marked the beginning of the Industrial Revolution. England became the leader of international trade and industrialization, and consequently has become the pioneer in the development of central banking and financial institutions. Later in the development of global banking, years later, other European countries put up in their banking institution. France began the overseas operation of its financial institution in the 1870s. German banks also participated in international banking in 1886 with the establishment of an overseas bank in South America. In the case of the United States, its banks developed into transnational bank. Later on, their global banking operations began after the Act of 1913, which authorized the establishment of overseas national banks to exchange for the foreign trades of the United States. A later comer in global banking is Japan, which started as international banking operation during the late 1950s. It is noted that the global banking expanded only during the last 20 years. Its expansion has been primarily caused by the growth of multinational corporations which control production and trade all over the world. The biggest bank in the world. For the first time, the 10 biggest banks in the world were Japanese as of March 1989. American and French banks have fallen out of the top ranks. Daiichi Kangyo Bank Ltd. was the biggest bank in the world with the assets of $387 billion. Citicorp, the biggest US bank and number 10 on the list in 1987, has slipped into number 12 with the assets of 203 billion of the end billion dollars at the end of the 1988. The biggest non-Japanese bank was the Agricole Mutual of France. It had assets of 200 billion at the end of 1988. It was number 8 on the list in 1987. Here's the 20 biggest bank of March 1989. 1. Dai-ichi Kangyo Bank, Ltd. Tokyo, 386,937. 1. Top 1. 2. Sumitomo Bank Ltd. Osaka, 376,288. 3. Fujisawa Bank Ltd. Tokyo, 364,044. 3. Sanwa Bank Ltd. Osaka, 348,358. 5. Mitsubishi Bank Ltd. Tokyo, 343,593. 4. Industrial Bank of Japan, Tokyo, 257,578. 6. Norinchuki Bank, Tokyo, 241,947. 7. Number 8, Tokai Bank Ltd. Nagoya, 225,121. Number 9, Mitsui Bank Ltd. Tokyo, 219,666. 11. Mitsubishi Trust and Banking Corporation, 210 to 266. 12. Credit Agricole Mutual, 207,938. 8. 12. Citicorp New York, 203,827. 10. 13. Sumitomo Trust and Banking Osaka na 196,516. 14. 14. Banque Nationale de Paris na 194,316. 13. 15. Barclay Ping London 198,198. 19. 16. Mitsui Trust and Banking Co. Company Tokyo 183,873. 15. 17. National Westminster Bank London 178,343. 21. 18. Credit Lyonnais Paris 176,663. 17. 19. Teiyoku Bank Ltd. Tokyo 178,670. 20. 20. Bank of Tokyo Ltd. 173,373. 24. Expansion of global banking. The growth of the multinational corporation has been one of the major factors of the rapid expansion of the global banking. The transnational banks supports the global manufacturing and trade of transnational corporation. On the other hand, the transnational corporations provide good business of the transnational bank. Indeed, there is a consistent symbiotic relationship among international industry, trade, and finance. They depend on the other from growth and viability. Another factor in the expansion of global banking has been the growth of the euro-dollar market. Such currency market was set up in the 1950s when the British Bank began. Accepting US dollar deposit and made this available for loans. A few years later, other banks, including US Bank, participated in euro-dollars business, such as practice of accepting US dollar deposits for loans outside to the United States is called euro-dollars market. Subsequently, other currencies were traded in euro. In view of this change, most bankers now prefers to call the euro-dollars market the euro currency market. The euro-dollar market has tremendously expanded since its organization has been able to generate a large supply of dollars and other currency. The growth of the aforementioned currency market has been mainly due to the following. 1. Increased profits of the transnational corporation, rise of petrodollars of the oil-producing countries, the Middle East, and outflow of the dollars from the United States as a result of U.S. military economic spending in foreign countries and foreign investments by the U.S. corporation. Other factor, the less developed countries are basically exporter of one to primarily products are likely coffees and sugar and raw materials like logs and fibers for the industry of the highly developed countries like the United States, Japan, and those in Western Europe. On the other hand, LDC import finishing products like machine cost price are very much higher than the raw materials they sell to say the rich country. The process involves exploitation of the poor countries due to low price of their primary crops and raw materials. As a result, the poor countries always suffer from the balance and payment problem. This means that their expenditure on import is much bigger than incomes from export. This is one principal reason why the poor countries become poorer and the rich countries richer. The resources of the former go to the latter. The only option given to the poor countries to be able to finance their socio-economic development is to borrow money from international financial institutions and from the government of rich country. Taxes are not enough to fund the highest cost of development. Poor countries have very limited sources of taxes because of their few industry and sufficient economic activities. Most of their peoples are poor and have low incomes or jobless. Before the 1970s, the WB and IMF and the governments of the rich country funded most of the borrowing in the poor countries. However, in recent years, the transnational banks have played a major role in supplying loans to the developing countries. The world has been lucrative market for the transnational banks. In addition, the technological factor has similarly contributed to expansion of global banking. Advances computer technology and other modern facilities have accelerated the government and financial resources throughout the world. International financial transactions have become more efficient. For example, money can be transferred from a bank in Europe to another bank in Asia in a few minutes. This is made possible through electronic transfer funds between banks, transnational banks, and transnational corporations. Transnational banks have been closely linked with multinational corporations. About 80% of the capital structure of 1,000 Japanese major companies from loans. The Zaibatsu large business organization financed the industrialization of Japan. In addition to farm taxes, said business organization cover mining insurance, banking, and other commercial industrial enterprises today. A bigger Zaibatsu control Japan economy. These are the giant financial instrument. These are the giant financial and industrial complexes. The United States are also business groups. For example, each of the 17 major business empires in let's switch one of the member, the top US bank like Citicorp, Chase Manhattan, Chemical Banks, and First National Bank of the Chicago are all part of the Rockefeller's group of 100 companies. The Morgan Groups are near 80 companies, as also several financial institutions in the business organization. In the case of the Bank of America, it has a group about 40 companies, which includes Union Oil, Getty Oil, Kaiser, Industrial, and Lockheed, among others, manufacturer Hanover Trust and Prudential Insurance, both larger financial institutions, had a group of 13 firms such as Chrysler Corporation, Union Carbide, RCA, among others. Global banking in the Philippines. Our country is part of the global banking system. The transnational banking constitutes a big portion of the Philippines financial system. They are established their branches and offshore banking units in the Philippines. Others have shares of established domestic financial institutions. Because of the use of financial resources, they can dominate the Philippines financial system and even the whole economy. The major client in the international clients of the transnational banks of the Philippines, government branches and subsidiary of multinational corporation in the top 100 1,000 corporation as of mid-1981 of the Philippine National Bank. In 1982, our country was the seventh biggest borrower among the countries in the Asia Pacific region. Our country has also the lowest credit rating in Southeast Asia. Top multinational bank of the United States, Japan, Canada, Great Britain, France, and Spain, Canada, their banks operation in the Philippines through their branches, offshore banking units, representative office, and or equity investment in domestic financial and enterprise. These are American banks, top 10. Bank of America, Citibank, Chase Manhattan, Manufacturer Hanover, JP Morgan, Continental Illinois Chemical Bank, First National Bank of Chicago, Security Pacific Bank, Banker Trust, Japanese Bank, Bank of Tokyo, Fuji Bank, Mitsui Bank, Taiyo Co., Export-Import Bank of Japan, Mitsubishi Bank, Sanwa Bank, European banks, Banco Español de Credito, Bank of Nova Scotia Bank, Banque de Paris et Pays Bas, Barclays Bank, Credit Lyonnais, Lloyds Bank, Societe Generale, Royal Bank of Canada, Bank of Montreal, Banque de Indochina et de Suez, Chartered Bank, Banque Nationale de Paris, Hong Kong and Shanghai Bank, Trade and Development Bank. Okay, to all my friends and viewers, I will be right back. Wait for a while, 10 to 15 minutes. Okay, let's continue to our discussion. Sorry for interruption. I will charge my cell phone. Now let's proceed. Money, credit, and banking, global banking. TNB's penetration. During the post-war years, there was a conscious effort to limit the participation of foreign banks to the four branches of transnational banks established since the colonial periods. These are chartered banks, British, Hong Kong and Shanghai Bank, British boats organized in 1975, Citibank, US organized in 1982, and the Bank of America established 1947 in spite of the provision of General Banking Act which allowed 40% foreign ownerships to no new foreign investment ever existed. However, after the declaration of martial law in 1972, transnational banks were encouraged to do their business in the Philippines. In compliance with the recommendation of a joint IMF-CB survey in 1971, major monetary where undertaking banks were required to raise their capital to a minimum of 100 million. To be liable to meet such a requirement of the Central Bank of the Philippines, some local bank has to merge the financial resources. Other has to accept partnership with the foreign banks or funds knowledgeable about the Philippines financial system and have excellent contacts. A representative office is not allowed to accept deposits nor to lend dollars. Its main function is to generate business for its head office by identifying prospective loan applicants in the country. In other words, it serves as bridge between a potential borrower and the transnational bank. As of June 30, 1981, there was 27 transnational banks which have their representative offices in the Philippines. 30,000 of these offices are from the United States, 6 from Japan, the rest Hong Kong, Canada, France, India, New Zealand, Spain, and Switzerland. Equity investments. Many commercial banks, investment houses, and financing companies have foreign capital in their financial resources. This means foreigners are part of owners that of aforementioned financial institution. For example, Citibank and other transnational banks has equity in more than one of domestic financial institution. However, in some banks like RCBC, there are two or more foreign banks which have capital in one domestic bank. The top of investment houses and financing companies in the Philippines have equity of foreign banks. Likewise, the introduction of expanded commercial bank universal banking being recommendation of WBIMF mission in 1979 has been very favorable to the expansion of transnational bank operation in the Philippines. The concept of universal banking is good with its bigger capital mean of 1 billion. It's the advantage of enjoying the economies of scale is better service of a lower unit cost. However, a few local commercial banks are capable of raising the minimum capital of 1.5 billion. The government has encouraged them to merge even with the foreign banks in order to become universal bank. Clearly, such monetary policy has given transnational banks more opportunities to penetrate our inefficient financial system to their advantage. Various ways of TNB participation branches. The first branches of transnational banks in the Philippines were organized to support and facilitate American and British business interests. In the case of the Bank of America, its primary objective then was the finance trade between the United States and the Philippines. Is provided loan to sugar mills and plantations, tobacco, coconut, and abaca mills and plantation, and logging and sawmill companies for the development and agricultural export. Most of these mills, plantation, and companies were owned by the Americans. At present, about 38% of the customer of the Bank of America are the multinational corporation. At the end of 1982, the total assets of the four branches were estimated at 26 billion. It has been noted that the foreign banks have been operating in the Philippines with a very little capital of their own, just like the other banks with a very little capital of their own. Just like the other banks, transnational banks do not operate on their funds alone, but also on the saving on their depositor. A representative offices is the composed of the foreign executive who are represent is transnational bank in the Philippines. He assisted by necessary and perhaps by one of two Filipinos employees who are very owned by the lending transnational banks as of March 1982. Foreign equity investments reached 283.34 million and their profits were equivalent to 35% of their investment. Offshore banking. This means doing business with non-residents, that is, the client are not based on the host country. However, the Philippines government allow offshore banking units to transact business with residents of the country. This is already offshore banking. The goal of the Philippines is made Manila Regional Finance Center in Asia. Hence, it encourages offshore banking units to operate in the country in the hope of competing with the highly developed finance centers like Hong Kong and Singapore. And to attract offshore banking units, the government has extended tax incentive on their earnings. There was even an attempt to transform this into commercial banks, but the local banking community opposed it. The basic operations of the offshore banking units are to accept dollars and other foreign currency deposit and lend this to their clients. Most of the time, they act as middlemen between borrowers and transnational banks. For such services, they earn a fee. Offshore banking units are not supposed to extend peso loans, but they do it through an arrangement with central bank and with foreign currency deposits units of a local bank. Moreover, offshore banking units are allowed to confirm letters of credit for the Philippine-based borrowing client. Their clients are the Central Bank of the Philippines Government Corporation, domestic banks, and private corporations like the Philippines Airlines National Power Corporation, PLDT, San Miguel Corporation, others. Global financial institution, WIM and ADB, where we belong to the third world, which means our country in poor development. One basic feature of our economy is that we are deficient in financial resources. Our agricultural and colonial economy greatly contributes to our poverty of the developing country. There is a great need to set up the foundation for social and economic development like education, health roads, communication, and electrification, among other things. All these factors of development require huge funding since we do not have enough funds for our development. We borrow from the World Bank, International Monetary Fund, and Asia's Development Bank. Nevertheless, it's not easy to borrow development funds from aforementioned institutions. There are many policy and conditions which are imposed on borrowing countries. For instance, the Philippines monetary and fiscal policy came from WB IMF recommendation. Failure to comply with said recommendation means disapproval of our WB IMF loans. In the case of IMF, a standby credit is approval of risk or release has been delayed for a long time because the government has not been able to meet at once all the conditions of the IMF. Among other things, as condition included the devaluation of the peso, the increase of taxes, fiscal discipline, reduction and of liquidity in the economy, and the removal of prices, control of subsidies. According to the WIMF and ADB, their objectives and programs had been designed to assist the developing member countries in attainment of their social economic goals. However, not a few intellectuals have charged with that belting condition of this institution have only made the people poorer and their programs only held advanced multinational interests in the Philippines. The World Bank. A group of 44 allied nations met only July 1, 1944 at Bretton Woods, New Hampshire to discuss the monetary and agreed a monetary and financial problem of the post-war world. The delegates agreed to set up two complementary international financial institutions, the International Monetary Fund and the International Bank for Reconstruction and Development, popularly known as the World Bank. On June 1946, both WB and IMF opened for business. All the participants of the Bretton Woods Conference, except the Soviet Union, became the members of the two institutions. However, Cuba, Czechoslovakia, Czechoslovakia, and Poland subsequently terminated their membership. The World Bank is an integral institution corporate in form and all its capital stock are owned by its member government. The bank has two financial affiliates, the International Finance Corporation, which extend loans to the private industrial sector, and the International Development Association within the soft loan window of the World Bank. These two financial affiliates plus the World Bank constitutes the World Bank Group. Membership in the World Bank is a requirement for membership in IFC and ADA. Objectives of the World Bank. The objectives of World Bank, number one, to assist in construction and development of members countries whose economics were destroyed or disrupted by war, and to encourage the development of the productive facilities and resources of the less developed countries, to promote private foreign investment by means of guarantees of participation in loan, and to supplement private investment by providing suitable conditions and finance for productive purposes. 3. To promote a long-range balanced growth of international trade of the intermaintenance of equilibrium in the balance of payment by encouraging international investment for the development of the productive resources of the member countries, which increase productivity, the standard of living condition of labor, their territories. 4. To arrange the loan made of guarantee by the World Bank in relation to international loans through other channels of source so that the more useful and urgent projects will be given first priority. And 5, lastly, to conduct its operation with due regards to the effects international investment or in business condition in the member of countries, and to bring about smooth transition from a wartime economy to a peacetime economy during immediate post-war years. Capitalization and membership. The initial authorized capital stock of the World Bank was $10 billion. This was divided into shares of the par value of 100,000 each. 1988, the authorized capital stock of the World Bank was 78.8 billion. On every 5 years, the capital stock institution is reviewed to determine whether there should be increase or not. Based on the articles agreement signed and participation of Bretton Woods, comprise only member countries, the IMF may consider membership in the World Bank. As June 13, 1922, World Bank has 165 members. Each member country has subscription quota based on economic strength. The rich countries has bigger subscription of voting power. The United States has the biggest subscription with a voting power of more than 20% of total voting power granted by the bank. The biggest contribution to both IMF and WRU, United States, Japan, United Kingdom, West Germany, and France, Saudi Arabia, a late corner under category of the big one, has also become one of the biggest subscriber together, and except Saudi Arabia, the held percent of all World Bank votes as 1982. In the case of the Philippines, it had only 0.5% others in their voting powers. The Asian Development Bank. The Asian Development Bank (ADB) is an international development finance institution which is owned by its member countries. Its principal role is to help promote the economic and social growth of its development members countries through the financial and technical assistance. ADB began its operation in December 1966 with its headquarters in Manila. It has 49 members, 34 from Asia and Pacific regions, and 15 outside of the region. The regional members countries comprise 31 developing members countries and 3 developed members countries, while the 15 non-regional members countries are highly developed countries from Western Europe and North America, United States, Canada. The Banks of Financial Resources officers professional staff came mainly from the regional members country. For instance, the president ADB is always Japanese. This is a quite understandable because Japan is the biggest regional stockholder. The non-regional member countries contribute about 36% of the subscribed capital and talent of bank. These have been greatly benefited the operation of the ADB. Principal function of ADB. The ASEAN Development Bank helps the economic development of its less developed member countries and foster economic growth and cooperation in the regions of Asia and the Far East, including the South Pacific. To attain these objectives, the Asian Development Bank perform the following function. Number one, promotes the investment of private and public capital development purpose in the region. Two, utilizes the resources disposed of for granting loans to the less developed member countries in the region. Three, meets the request for the members of the region for assistance in their coordination of their development policy and plans. 4. Provides technical assistance for preparation, financing, and execution of development projects and programs. 5. Cooperate with the United States nation, its organs, subsidiary bodies, and with public international organizations as well as national entities, public and private, which are concerned with investment development funds in the region. And lastly, 6. Undertakes such as activities and provides as other services in relation to its tax. Criticisms against WB, IMF, and IDB. The four countries not being satisfied in their dealings with WB, IMF, and IDB. They claim that the loans policies of the aforementioned financial institution tend to favor more economic interests of the rich country rather than the poor country. For instance, not a few American and Filipino economists have accused the WB of wanting the poor countries to remain in their plantation economy or agricultural economy. It has been noted that the great bulk of WB, IMF, and ADB loans has been allocated to agricultural development, not on food production but on crops for transnational commercial purposes. Likewise, the aforementioned financial institutions demand free international trade and restricted foreign investment as condition, among other things, for the grant loans to the poor countries. Obviously, the products of the industries of the poor are no match with the products of the highly industrialized country. Under free trade, poor countries will forever remains importers of finished products. Countries will forever remains importer of finished product of the rich country and exporter of raw materials. This simply means the poor countries have no chance to industrialize their economies. Furthermore, the IMF policy of free trade appears to contradict its objective. Free tends to agree with balance of payments position of for developing countries. The latter has to control, enforce, and to protect in infant industry to traffic and other protective trade measures. If not, says country would be spending more for its imports than in income from export. This means deficit balance of payments, the imposition of free trade and foreign investments of the less developed countries vividly reveals the true intention of WB and IMF. The major stockholder of WB, IMF, and ADB are these rich or industrialized countries. There is no doubt that free trade of foreign investments in favor third industrial economies. Philippines' favorite customer of WBADB. Our country has been one of the favorite clients of the World Bank and Asian Development for general agricultural funding. Such favorable attitude of the bank towards the country issued to several major factors further 1980. The opening up of the country to foreign investment after the inauguration of the Marcos regime to the Philippines is a military output of the United States. The abundant and the beginning of the 1970s still largely unexplored agricultural and non-agricultural resources in the large parts of the country. Four, the cheap labor of the country, and five, the countries leading the role in the expansion of the Green Revolution, which favor the economic interests of the multinational agribusiness corporation. WB promotes private international capital. Cheryl Payer, author of WB Project Lending, said, "The World Bank has deliberately and consciously used its financial power to promote the interests of private international capital in its expansion to every corner of the underdeveloped world. It has worked towards this in many different ways. The different ways are, number one, pressuring the borrowing governments to improve the legal privilege for and moderate the tax burden on the foreign investment. Two, opposing the minimum wage law, trade union activities, and all kinds of measures which would improve the share of labor in the national income. 3. Insisting the procurement of inputs of WB projects through the international competitive bidding, which favor the largest multinational corporation. And last, number 4, financing projects and promoting national policy which deny control of basic resources, land of water, forest the poor people, and appropriates resources such of the benefits of multinationals and other collaboratives, local elites. Now, let's go to our money, credit, and banking, global banking question for review and discussion. Number 1, define a transnational corporation. 2, briefly explain the development of global banking. 3, name of the countries which dominate global banking. 4, state the factor which were responsible for the expansion of global banking. 5, what is the euro-dollar market? 6, discuss briefly the relationship between a transnational corporation and transnational bank. 7, explain the penetration of TNB is the Philippines. 8, briefly narrate the formation of WB. 9, explain one objective of WB and give your comments. 10, who are the biggest stockholder of the WB IMF? 11, why is the Philippines a favorite customer of WB ADB? 12, explain the relationship between WB IMF and international capitalism. This is the end of money, credit, banking, global banking. Now, I will continue this tomorrow in the morning, or maybe in afternoon. So I will give you the hints to all my friends and viewers, small YouTuber, for the next topic. So part 4, investment and international finance, introduction to investment, the role of IMF, international finance, exchange rates policy of the LDCs, and lastly, the social responsibility of financial management. All right. To all my friends and viewers, small YouTuber, welcome. Thank you for viewing, to visiting my channel. My pleasure. I love you all. God bless you all. More blessings to come. Again, kindly share this video for those small YouTuber to and also viewer in your community. Share it. And lastly, don't forget, number 1, don't forget to watch my old video. Number 2, don't forget to subscribe. Number 3, don't forget to like. Number 4, don't forget comment in the comment section box. And 5, don't forget to click all bell. Click all bell and you can receive any notification bell my old videos in my channel. All right. Thank you. Enjoy watching. God bless you all. More blessings to come and more power. Bye-bye.